Hello, this is the first lecture from Chapter 2. It will either be two or three lectures. I'm not quite sure yet. I don't really want them to be more than 20 minutes apiece, so we'll see how it goes. All right, but Chapter 2 gets into the actual recording of business transactions. Because if you remember me saying, we will not be using the accounting equation like we did in Chapter 1 to record transactions. We'll actually move to something referred to as journal entries. So let's get going. Let me see. All right, so just a little review. If you recall, the accounting equation is assets equals liabilities plus equity. Okay. Now, under each of these, we have accounts, like a cash account, a land account, a building account. Under liabilities, we might have accounts payable and things of that nature. All right, so an account is the detailed increases and decreases of these different items. So they do have an exhibit that shows you, more details with respect to different accounts. All right, so different types of accounts include, all right, this is a basic list. It's not all, it's not fully inclusive of all the accounts, okay? So cash is money that's in the bank or on hand. All right, and if you recall, it's an asset. Actually, let me change this up a little bit. I'm going to go like this. I'm going to put assets here. All right, account receivables is a customer's promise to pay. All right, so the business has the right to receive the money. All right, a notes receivable is very similar. It's a written promise. That a customer will pay. All right, it's more formal than an account receivable. And it typically includes interest. All right, a prepaid expense is where something has been purchased in advance of actually using it up. So it's an expense paid for in advance. We will often have prepaid rent, prepaid insurance. Those are two of the most popular ones that we'll see. But it could be any number of things. Prepaid advertising. It's not considered an expense until it's used. All right, equipment, furniture, and fixtures. All right, so it's the cost of these types of assets that are used in the business. All right, buildings, cost of the buildings, land. You might note that it's cost of land used in business. Sometimes you might have land that's an investment that you're not actually using. Okay, then we get down to some of the liabilities. All right, account payable is a promise to pay. Promise to pay a debt. A note payable is similar to a note receivable, but it's a written promise to pay. It's generally more formal than an account payable. and it includes interest normally. All right, an accrued liability these are expenses incurred that have not yet been paid. All right, so like utilities payable might be an example. Salary payable might be another example. All right, and then unearned revenue is cash received in advance of providing the service or good if you're selling something. All right, and it's a liability because you still owe them. You owe them the job. All right, and then equity we have the owner capital. Actually, you know what? I'm going to change this up because we're going to be doing a corporation, so I'm going to do it a little bit different. All right, we'll have contributed capital that we'll talk about, and this represents owner investments. Typically, that's the account that we're going to use is common stock. All right, in this class, we'll use common stock. Then we'll have retained earnings. And retained earnings is accumulated profits and losses less any dividends that have been paid. All right, so basically what happens, if you remember we did that statement of retained earnings in chapter 1, basically what happens is retained earnings is increased by net income or decreased by net loss, and then it's decreased by dividends. And also, if you recall, revenue minus expenses is how you get net income or net loss. Okay. Excuse my dogs. All right, a chart of accounts is simply a listing of all the business's accounts sorry, I know this is right. Accounts, and it's typically in financial statement order. And by that, I mean it's assets, liabilities, equity, such as common stock and dividends, and then revenue and expenses. All right, and then finally, the ledger is a book. I'm going to say book for lack of a better word. Of course, if you're using online software, it's not really a book. But anyway, the ledger is a book which holds all the accounts along with their balances. All right, so I can look at the cash account in the ledger to see how much cash I have at any point in time. Okay, now if you recall from this accounting equation up here, everything had to balance out around the equal sign every time. So we generally had to have an entry to two different accounts. We either had to have plus an asset and minus an asset, or we had to have plus an asset minus or plus an asset plus a liability. You know, everything had to balance out. Now, what that's referred to is a double entry system of accounting. Okay. All right, that is what we'll be using. All right, so each transaction affects at least 2 accounts. Okay. And generally speaking, one account, well, I'm not even going to say that. Never mind. But it has to affect at least 2 accounts. All right. Now, in talking about the accounts, and I think I kind of touched on this a bit in chapter 1, but we will oftentimes use what's called a T account. All right. This is an informal representation of an account in the ledger. All right, so they're using cash, so I'll use cash. Oh my gosh. All right, so it's called a T account because it looks like a T. All right, you have a line going across the top and then a line down the middle. Okay, when you're using accounts and double entry system of accounting, you've got entries on the left-hand side and you have entries on the right-hand side. Okay, left is the same thing as debit. All right, so that's all the word debit means is you're making an entry on the left-hand side. Credit also means right. All right, so if you say you're going to credit something, you're making an entry on the right-hand side. That is all it means. Left means or debit means the left-hand side. Credit means the right-hand side. Okay, that's all it means. So then you can apply that to the accounting equation. So let me type this out. I'm going to pause for a minute while okay, so I finished typing this out. So now you can apply the same thing to the accounting equation as a whole. If you notice, assets are on the left-hand side. So the normal balance of an asset will be a debit, and you increase assets with a debit. Okay? Then you would decrease them with a credit. Okay? Since liabilities and equity are on the right-hand side, their normal balance will be a credit, and you'll increase with the credit. And you would decrease with a debit. Okay? And then this same applies to the equity accounts. Okay? And it's because assets are on the left side, liabilities and equity on the right side. So then it follows along with what left and right mean. Okay? So if I want to increase cash, I would make an entry on the left-hand side. If I want to decrease cash, I would make an entry on the right-hand side. So I would increase with the debit, I would decrease with the credit. And all assets would work that same way. Okay. Then if we expound on that, under equity here, that's all they've done right here, is they've just split it up. So when you have an investment, your equity goes up, so that would be recorded with the credit. All right, if you pay dividends, equity is going down, so that would be a debit. Revenue ultimately increases equity, so that's a credit. Okay, let's see. Let me back up. Investments are recorded with a credit because they, oops, I don't know what happened. Increase equity. Dividends are recorded with a debit because they decrease equity. Revenue is recorded with a credit because it increases equity. And expenses are recorded with a debit because they decrease equity. All right, then they have a little table that you can look at. It's in your book as well, that just summarizes how you increase or decrease certain accounts or types of accounts and what their normal balances are. All right, and then finally, if you want to find out the balance of an account, you add up the debits and subtract the credits. So let's copy this over. Oops. Let's just copy this. And so we had, So we had 30,000 on the debit side, 5,500, and then 20,000 and 3,200. Okay, so this assumes that you know that debits are increasing and credits are decreasing. So what you do is you add up the sum of the debit side. So you would have 35,500 over here, and then you would have 23,200 over here, and then you subtract. So you would do 35,500 minus the 23,200. All right, and that's how you get the balance. And we kind of did this. No, we didn't. I did it. So I'm actually going to sum, because I think when you're using Excel, you can sum up one side and then subtract the sum of the other side. And there is your balance. Okay, I think that's going to be it for this video. So be sure to go on to the next video, because we will do journal entries, which are very, very important. So you need to make sure to watch the next video.